Welcome back to the Chart Ledger Deep Dive. Today, we're plunging into a world that many find complex, often controversial, but definitely fascinating: the mechanics of short selling. We've gathered a stack of sources for you, looking at everything from finance guides like Investopedia and Charles Schwab to real world insights from Reuters and Wikipedia. Our mission to unpack this often misunderstood strategy, really peel back the layers on its unique risks and surprising rewards, and understand why it's such a critical yet, well, endlessly debated part of our financial markets. Get ready, because we're talking about everything from the terrifying prospect of unlimited losses to those dramatic short squeeze sagas that have made headlines worldwide. Okay, let's unpack this. So most of us get traditional investing, right? You buy low, hope it goes up, sell high. Pretty straightforward. But short selling flips that completely. You're betting on a decline. For those who maybe know the term but aren't quite sure how it works, how does this, well, counterintuitive strategy actually play out?
Yeah, it's fascinating because it really is betting against a stock, but the mechanics, the sequence is key. An investor starts by borrowing shares, usually from their broker. Then they immediately sell those borrowed shares on the open market.
Okay.
Now they're holding cash, but they owe shares back. The hope is, of course, that the stock's price will drop. If they're right and the price falls, they then go back to the market and buy the same number of shares, but now at that lower price.
Oh, okay.
And then they return those newly purchased shares to the lender, the broker they borrowed from initially. So the profit is that difference, right, between the higher price they sold at initially and the lower price they bought back at, minus, of course, any fees or interest.
Right.
So, like the example, if you sell short at $50 and manage to buy it back later at $40, that's a $10 per share profit before costs. It really does flip the script. You're looking for overvaluation, not undervaluation. It takes a certain kind of contrarian mindset and a lot of analysis.
And you mentioned costs. It's not free money.
Definitely not. You absolutely need a margin account. That means putting up collateral like a security deposit against potential losses. And you usually pay interest on those shares you borrowed for however long you keep the short position open. So there are ongoing costs ticking away.
Okay, so there's real capital at stake, ongoing costs. It sounds complex. Given that, who typically engages in this kind of, well, high stakes play? Is it something everyday investors are doing, or is it more the domain of the pros?
It's mostly the pros, yeah.
Hmm.
Experienced traders and institutions. Now, technically, individual retail traders can short stocks if they have a margin count and meet the broker's requirements. But honestly, they face much higher risks and the requirements can be quite strict.
Right.
So in practice, the vast majority of short selling activity comes from larger players. Think hedge funds, other big professional investors. They use it when the research suggests a company is, fundamentally overvalued or maybe heading for some kind of trouble. You also see market-making firms using it and option traders too, often for hedging.
Hedging. What does that mean in this context?
Well, it's about reducing risk. So maybe a fund owns a lot of stock in one tech company but is worried about a competitor. They might short the weaker competitor to kind of offset some of the risk in their main holding, or they might use it to create a market-neutral position.
I see. So it's a strategic tool for them, not just a bet on falling prices.
Exactly. It's often part of a bigger strategy, not usually just a casual punt.
And when these players, these experienced traders, get it right, when their bearish view pays off, how exactly does the profit mechanism work again, just to be clear?
Sure. They make money simply if the stock price goes down after they've done that initial sale of the borrowed shares. It really is sell high, buy low, just in a different order.
Right.
They typically target stocks where they expect something negative is coming, maybe bad earnings, weak fundamentals are about to be revealed, or maybe the market just got way too optimistic and a correction is due. If they're right and the stock does slide, they then cover their short.
Cover means buying back.
Exactly. Buying back the shares at that new lower price. They return the shares, and the difference between their initial sale price and the lower buyback price is their gross profit. So like selling 100 shares at $50 nets them $5,000 initially. If it drops to $40, they buy back 100 shares for $4,000. Return the shares. They keep the $1,000 difference minus those costs we talked about.
Got it. It highlights that it's not just luck. It often involves deep research to predict that drop.
Absolutely. High conviction, research intensive stuff usually.
Okay, so profiting from a fall sounds clever, potentially lucrative, but, our sources really hammer home the risks and this idea of unlimited losses. That just sounds terrifying. How does that actually work? What's the danger there?
Yeah, that's the crucial difference, and it's a big one. With a normal long investment, right, you buy a stock. The worst that can happen is it goes to zero. You lose what you put in.
Right. Your initial investment is your max loss.
Exactly. But with short selling, there's no theoretical limit to how high a stock price can go. If you short sell at $50 and the stock, instead of falling, starts climbing to $60, $100, $200, your losses just keep mounting. There's no built-in cap.
Wow.
So if you shorted at $50 and had to cover at $100, you've lost $50 per share. Multiply that by a large position. It gets ugly fast. And remember the margin account?
The collateral.
Right. If the stock price goes up, your losses are increasing, and your broker sees that, they might issue a margin call.
Meaning they want more money.
Exactly. They demand you deposit more funds into your account to cover the growing potential loss and maintain the required margin level. If you can't meet that margin call, if you can't pony up the extra cash, the broker has the right to forcibly close your position. They'll buy back the shares on your behalf, often at the worst possible time for you, crystallizing those losses. It can literally wipe you out.
Okay, so it's not just the potential for big paper losses. It's the very real risk of being forced out and losing everything.
Yeah.
That's intense pressure. And this brings us to the short squeeze. This is where things can get really wild, right? This
Yeah.
is what happened with GameStop and those meme stocks that everyone was talking about. Can you walk us through that?
Yeah, the short squeeze is probably the biggest nightmare for a short seller. It's like a financial trap springing shut. It happens when a stock that has a lot of short interest, meaning many people are betting against it, suddenly starts to rise rapidly. Maybe there's unexpected good news, or maybe just a sudden surge of buying, like we saw with GameStop.
Right, the Reddit crowd piling in.
Exactly. So the price starts going up. Now all those short sellers see their positions going into the red. To limit their losses, they feel forced to buy back the shares to cover.
But wait, if they're all buying.
That's the squeeze. All that forced buying pushes the price up even faster. It creates this vicious feedback loop. Rising price forces shorts to cover. Covering pushes the price higher, which forces more shorts to cover.
Wow, a cascade.
A cascade, exactly. The upward momentum just explodes, and short sellers can face astronomical losses in a very, very short period. They're squeezed out of their positions at terrible prices. GameStop in 2021 is the textbook example.
Yeah.
You had this stock, GME, trading around $20. Then this wave of retail buying, coordinated online, sent it rocketing past $400 in just a few weeks.
Unbettable.
It absolutely crushed some big hedge funds that had large short positions. Reports estimated short sellers lost something like $6 billion just in late January that year.
Ouch.
And we saw it again, maybe less extreme, but still dramatic, with AMC Entertainment.
Yeah.
June 2021, the stock jumped something like 83% in a single day. Short sellers lost around $2 billion just in that week. It shows how violently the market can turn against shorts when that squeeze dynamic kicks in.
Okay, so it's definitely not for the faint of heart. But you mentioned earlier it's not always just about betting on a fall, pure speculation. Our sources talk about different types of short sellers, different motivations. Could you break those down for us?
Yeah, that's a really important point. Not all short selling is the same. You've got different players with different goals. First, you have the speculators. These are the ones most people think of. They're making a directional bet, pure and simple. They've done their research, they believe a stock is overvalued or faces bad news, and they short it, hoping to profit from the decline.
Okay, the classic bet against types.
Right. Then you have hedgers. We touched on this. These are investors using short positions not just to profit from a fall, but to reduce risk in their overall portfolio. Like that example, a fund might be long one company in an industry, but short its weaker rival. They're hedging their bets, maybe aiming for a market-neutral position or just protecting against sector-wide downturns. Long-short funds do this all the time.
Makes sense. Managing risk.
Then, market makers. These are usually brokerage firms whose job is to facilitate trading, to provide liquidity. If lots of people want to buy a stock right now, but there aren't enough sellers, a market maker might step in and sell shares short just to complete those buy orders smoothly.
Ah, so they're not really betting against it long term.
Not usually, no. They aim to quickly buy back the shares or offset the position. They're providing a service, keeping the market flowing. And finally, you have activist short sellers. These are maybe the most controversial, but also sometimes the most impactful.
Like Hindenburg Research.
Exactly. Firms like Hindenburg or historically Citron Research, they do incredibly deep investigative research into companies, looking for signs of fraud, accounting irregularities, terrible management, or just massively inflated valuations. Then they publish detailed, often scathing reports laying out their case while holding a short position. They profit if the stock collapses after their allegations come to light.
So they're betting on their own research uncovering problems.
Precisely. Hindenburg's report on Nikola, the electric truck company, is a prime example. They accused it of extensive fraud, faking demos. Shortly after, the stock tanked. The founder resigned.
Yeah, I remember that.
And they did it again with the Adani Group in India in 2023. Huge conglomerate. Hindenburg accused them of massive fraud and stock manipulation. Adani stocks lost something like $150 billion in value within weeks.
Wow. Real impact.
Definitely, though it doesn't always work out. Andrew Left at Citron famously shorted GameStop, published a bearish case, and got absolutely run over by the squeeze. He announced he was covering at 100% loss and even stopped publishing short reports for a while after that. So even for activists, it's high risk.
Okay, so a few different types there with very different reasons for shorting. Looking beyond the individuals or funds doing it, what does all this mean for the market as a whole? Do short sellers actually serve a useful purpose? Or are they just, vultures profiting from misfortune?
Well, that's the million-dollar question, isn't it? And the consensus among most market experts and economists actually is, yes, they do serve critical functions. The big one is price discovery. Think about it. Markets work best when prices reflect all available information, right? Both positive and negative. Short sellers are actively looking for negative information. Maybe uncovering fraud, maybe just identifying that a company's prospects aren't as rosy as the market thinks. By selling the stock, they push that negative information into the price much faster than might otherwise happen.
So they help correct overvaluations quicker.
Exactly. They act as a counterweight to excessive optimism or hype. Charles Schwab's materials specifically mention their role in price discovery and liquidity, two components of healthy and efficient markets. History shows they've played a role in exposing major frauds, like Enron, sometimes years before the final collapse. They can be an important check on corporate behavior.
Okay, price discovery. What about liquidity?
Yeah, they add liquidity, too. By being willing to sell shares, even borrowed ones, they add to the trading volume. This can make it easier for everyone to buy or sell when they want to, potentially leading to tighter spreads, the difference between the best buy price and the best sell price. This is especially true in falling markets, where short sellers might be among the few active sellers. It's interesting, even Warren Buffett, who's famously a long-term buy and hold guy, has said something like, the more shorts, the better.
Really? Why would he say that?
His reasoning is that every share sold short represents future buying demand, because eventually every short seller must buy back the shares to close their position. So a large short interest can actually provide a potential floor or fuel a rally down the road.
Huh. That's a counterintuitive take.
It is. But it highlights the idea that, for advocates, short sellers aren't wreckers. They're more like market watchdogs, helping keep things efficient and honest.
Okay, that makes a strong case for their role. But let's be real, short selling is super controversial. You hear people calling it unpatriotic, damaging, companies hate being targeted. Why the bad reputation, and what do regulators do about potential downsides?
You're right, the reputation is definitely mixed. A lot of the criticism comes down to perception and optics. Profiting when a company stumbles, potentially costing jobs. It just feels wrong to some people. It can seem predatory.
Yeah, we can see that.
And targeted companies, naturally, often fight back hard, arguing the shorts are spreading false rumors or deliberately trying to undermine confidence for their own gain. Historically, especially during market crashes, politicians have sometimes blamed short sellers for making things worse, for driving prices down unnecessarily.
So have they ever just banned it?
There have been temporary bans, yes. Usually during extreme crises, like after the 2008 crash in some markets, or some countries did it briefly during the COVID panic in early 2020. But generally, studies suggest these outright bans don't really help stabilize markets long-term and might even harm liquidity and price discovery.
So regulators focus on rules instead.
Exactly. Rather than banning it, they regulate it tightly to prevent abuse. There are rules against market manipulation, things like bear raids, where you coordinate to spread false negative rumors while shorting heavily. That's illegal. The SEC goes after that.
Okay, so spreading lies is out.
Definitely.
Definitely something to mull over. Thanks for joining us on this Chart Ledger's deep dive. We really hope you feel a little more in the know about this pretty fascinating corner of the financial world. Until next time, keep digging.